There's a detail about Warren Buffett that nobody really talks about, and it's not the Dairy Queen blizzards or the ukulele, it's this. The man has given the same financial advice to two completely different groups of people, and the advice directly contradicts itself. He tells everyday investors to do one thing, and then in the next breath, he tells you what he personally would do. And the gap between those two answers is so wide that if you don't understand why they're different, you'll spend the next decade doing the wrong one. My name is Daniel, and today we're going to sit inside that gap because the answer you choose matters more than the amount you're starting with. Let me paint the picture first. Buffett is 94 years old. He still lives in the same house in Omaha he bought in 1958 for $31,000. Every morning he drives to McDonald's and orders one of 3 breakfast combinations, depending on how the market opened the night before. I'm not making that up. His wife used to hand him exact change. He is, by any reasonable measure, the most successful investor in recorded financial history. And when people ask him what to do with $10,000, they expect to hear something profound, something coded, something that feels like being handed the answer key. What they get instead is almost offensively simple. And then, if they push him, they get something else entirely, something that sounds like a completely different man. The public answer, the one he wrote into the instructions for his own wife's inheritance, is to put 90% into a low-cost S&P 500 index fund and 10% into short-term government bonds. No stock picks, no sector rotation, no timing the market around Federal Reserve announcements. Just a fund that quietly owns 500 American companies and asks nothing of you in return. That's what the man who built a trillion-dollar empire through decades of surgical stock selection trusts with the money belonging to the person he loves most. Let that sit for a second, because it should feel strange. It should feel like finding out the greatest chef alive feeds his family frozen dinners and genuinely believes that's the right call. Here's where most people get confused, though. They hear index fund and they think it means settling. They think it's the financial equivalent of admitting you're not smart enough for the real game. But Buffett's reasoning isn't about intelligence, and understanding that distinction is worth more than any specific stock he's ever mentioned in a shareholder letter. His reasoning is about structure. The game is rigged in a specific way, and the index fund is the only tool that uses the rigging in your favor instead of against you. Every fund manager on Wall Street is charging you fees and trading costs and still, on average, underperforming the very index they're trying to beat. Buffett actually bet $500,000 on this in 2008, a plain index fund against a professionally curated basket of hedge funds. After 10 years, the index had returned over 125%. The hedge funds averaged just 2% per year. The people paid to beat the market, with entire floors of analysts and proprietary software and Ivy League pedigrees, lost to a fund that does essentially nothing. That's not a fluke. That's a structural reality that Buffett spent decades watching compound. Now, before you take any $10,000 and put it anywhere, Buffett would stop you at the door with a question that has nothing to do with the stock market. He'd ask you if you have any debt charging you 18% or more. And if you do, his answer is almost uncomfortably direct. Pay it off first, because he doesn't know how to make 18%. That line tends to confuse people when they first hear it. This is the man who compounded at roughly 20% annually for over 60 years, and he's saying he can't reliably beat your credit card rate. But think about what he's actually telling you. A credit card charging 24% APR is a guaranteed, tax-free, risk-free 24% return the moment you eliminate it. No investment on earth offers that without uncertainty attached. The debt eats before the market does, and pretending otherwise is one of the most common and quietly expensive mistakes in American household finance. If you're in that boat, carrying high-interest debt while also thinking about investing, you're essentially pouring water into a bucket with a hole in the bottom and congratulating yourself on your pouring technique. Most people don't frame it that way. They frame it as multitasking, as being financially active on 2 fronts. But the math doesn't care about the framing. Every dollar earning 7% in an investment, while a separate dollar is costing you 22%, is a net loss disguised as progress. Buffett saw this clearly enough to put it before everything else in his answer. Once the high-interest debt is gone, he'd want to see a cash reserve, money sitting somewhere, accessible, not invested, not optimized, just present. And here's the part of this that's actually changed in the last few years. Borrowing cash finally pays something. High-yield savings accounts and short-term treasury bills have been sitting around 4 to 5%, which means your emergency fund is no longer just an emotional safety blanket. It's modestly productive. If you're new to the channel and this kind of straightforward financial psychology is what you're here for, hit subscribe. This is what we do here, and there's more coming. Now we get to the second answer, the one Buffett gives when someone asks not what he'd tell you, but what he himself would do with $10,000 if he woke up tomorrow with no reputation and no network. And the number he reaches for is 50% per year. He said it in 1999. He repeated it at 93 years old in 2024. He said he could guarantee it. And when you trace back what young Buffett actually did to produce numbers close to that, it looks almost nothing like what finance content typically describes as investing. There were no charts, there was no trend analysis, there was no thesis about macroeconomic cycles. What there was something much closer to obsessive detective work. At 20 years old, he found out that a Graham disciple sat on the board of a small insurance company called Geico. He took a train to Washington on a Saturday, got a janitor to let him into the building, and proceeded to interrogate the only executive working that day about insurance economics for 4 hours straight. Then he put 2/3 of everything he had into the stock. That's not investing the way people talk about investing. That's a level of conviction that borders on uncomfortable. The broader playbook from that era was even more painstaking. He sat down and read through every single page of Moody's manual, 20,000 pages covering every public company in America, looking for companies so cheap that the math almost didn't make sense. He found a company called Western Insurance Securities, earning $29 a share and trading at $12. He and a friend physically drove through rural Nebraska, buying old paper stock certificates from farmers who'd received them as gifts decades earlier and basically forgot they existed. This is the 50% strategy in practice. It's not a mindset, it's a lifestyle built entirely around finding pricing mistakes before anyone else notices them. And it worked spectacularly. His partnership from 1957 to 1969 compounded at roughly 30% per year, while the broader market did about 7%. $10,000 with young Buffett in 1957 became around $160,000 by 1969. Here's the part that makes this entire question so interesting, though. Buffett himself says the 50% answer is now closed to him. Berkshire Hathaway is sitting on nearly $400 billion in cash and treasury bills. When you're that large, finding a $50 million mispriced company and watching it go tenfold barely registers. The structural advantage he's describing when he talks about small money is real, and it belongs to you, not him. You can walk through investment doors he physically cannot fit through anymore. But, and this is the honest part, he also says that advantage only means anything if you're willing to do what he actually did. Not follow tips, not watch the sector rotate, actually fall in love with reading financial statements the way some people fall in love with sports statistics. He said it plainly, you have to be in love with the subject, not just with the idea of returns. If that kind of obsession sounds appealing to you, the small investor edge is genuinely structural, and Buffett himself has said he envies it. If it doesn't, if reading a decade of earnings reports sounds like a punishment, then the index fund isn't the backup plan, it's the plan, and it comes with his name on it. So when you hold both answers up side by side, they stop looking like a contradiction and start looking like a mirror. Buffett isn't giving two different pieces of advice. He's asking you one question. Which one are you actually are? Because the 50% answer isn't gatekept, it's not hidden. He described the entire methodology in detail, and his early letters are publicly available. What's scarce isn't the information, it's the obsession. And the index fund answer isn't a compromise for people who didn't try hard enough. It's the answer that comes from watching professionals fail at this for decades and concluding that patience and low fees and time are more durable edges than brilliance. The math on a $10,000 investment growing at 10% annually for 30 years reaches something close to $170,000, not from cleverness, from staying.
That's the quiet thing Buffett has always known and kept saying out loud, even though nobody wants to believe it. The market's biggest enemy isn't the economy or inflation or bad policy. It's the person sitting in front of the brokerage account who can't leave it alone. The question I want to leave you with is this. If you're being honest with yourself, which version of the Buffett answer fits the life you're actually living? And does the way you currently handle money match that answer? Drop it in the comments because I think most people haven't really asked themselves that question yet.